Now, earlier this year, Naspers sold 190 million shares in Tencent worth $9.8 billion. Now, the Internet and Media Group has seen its stock declining following this, with Tencent weighing down its performance as well. Now, what does the unbundling of Naspers mean for South African investors? Arthur Karas is fund manager at Old Mutual Age 28. He joins me now. Arthur, thank you for taking the time and sharing your insights with us. First of all, let's establish a few things. Yes, you are holders of Naspers, right?
Yes, we are.
Yes, you've benefited from the phenomenal run that we have seen in this stock.
It's been a large holding in our portfolios for a number of years.
And you would also be amongst those investors who have been, I'm sure, frustrated by the fact that you have this huge discount in Naspers' asset base as well versus the valuation of the company on the markets.
So you would expect a situation like Naspers, or an investment opportunity like that, to attract a discount. Naspers doesn't control many of the holdings that it has, doesn't control Tencent, doesn't control all of the holdings that it has in its smaller internet e-commerce investments. So you'd expect that to attract a discount, but usually that discount would be somewhere between 15 and 20%. The discount has been as wide as 60% and is currently about 40%. So the discount's simply too large.
So you are amongst that group of investors that says an unbundling would make sense, correct?
Well, you need to take a comprehensive approach here. I think an unbundling, simply breaking the company up into its constituent parts, wouldn't suit Naspers at this stage of its development. It needs the size and scale of its investment in Tencent to help it achieve some of its strategic objectives. And I think we as investors understand that. So we're not expecting Naspers to unbundle it in its entirety, but we are expecting it to take a number of actions that we think will help narrow the discount.
Okay, so in terms of time frames, what would you be looking at if the company were to listen to you? Oh, we seem to have just lost Arthur at a crucial point in our conversation. I'm hoping that I will be able to get him back, because I think this is an important conversation given the size of Naspers on the South African markets, and for the market to simply write off 40% of the company's value because it's not seeing its way through, if you like, over the whole for a company is certainly a difficult time. I'm hoping that we'll still be able to get Arthur and continue that conversation and finish it off before we move on to our next conversation. He seems to be back with us now. Arthur, I'm hoping you are back, yes?
Yes, I am.
Well, Naspers could do something about some of these things, because it's in within this technology space, and it certainly could help us improve communications. But let's talk about your ideas of what a really nicely unbundled Naspers would look like.
So they've put forward a number of suggestions in their communications with the market. These include listing some of the e-commerce investments when those investments are at the right development stage for that. So not all of these companies are at the right point in their life cycles to make a listing opportune. But I think the main thing that they need to focus on is finding more shareholders, or a different shareholder base for the Naspers, for the overall Naspers company. It's simply very, very large in the South African index. It doesn't have there's not much room for most South African investors to add more Naspers in their portfolios. So we believe that they're exploring the potential of seeking an alternative listing for Naspers. They've indicated that they don't wish to do a dual listing, but we do think some kind of a primary listing is being explored by the company. We don't have more details other than that, but we're quite keen for them to share their plans with the market when they've worked them out.
As Old Mutual, what would you prefer?
Well, we certainly don't want to be cut off from the ability to invest in Tencent on our market, because you can currently get access to a very large global IT internet company by investing in Naspers. We also don't want to not be able to invest in the underlying portfolio. There's a lot of very interesting companies there. They've clearly created quite a bit of value. You can see how they recently sold their stake in Flipkart, which generated a lot of capital for the shareholders. So ideally, we'd like to see them find an alternative listing somewhere else that would allow a more easy arbitrage between Naspers and Tencent, but still allow South African investors through the JSE to be able to invest in Naspers, the underlying portfolio of e-commerce companies as well as Tencent.
Would you like to see perhaps the African assets standing on their own?
Well, the African assets currently are mainly, we're talking about the pay TV business and the Media 24 business. The pay TV business is really the biggest part there, and it does give you some interesting access to Africa. Those businesses are currently helping fund the e-commerce businesses. So that creates a EBITDA neutral situation for those two parts of the business, and we don't think that it makes sense at this point to split them up. But in the longer term, the pay TV business is a mature business. It doesn't really match with the other online internet businesses, and you'd expect the pay TV business to be spun off or sold. I think that's a realistic expectation, but we wouldn't expect that to happen in the short term.
Absolutely. Arthur, thanks very much indeed. Let's leave it there for today.